Accounting Fundamentals Problem 2. Grapefruit Services, a sole proprietorship, started the year with total assets of $90,000 and total liabilities of $55,000. The revenues and expenses for the year amounted to $100,000 and $60,000 respectively. During the year, there were no new capital contributions and the owner withdrew $40,000. What is the amount of owner's equity at the end of the year? This question is extremely important because it's asking about the amount of owner's equity at the end of the year. Remember the accounting equation. The accounting equation is assets equals liabilities plus equity. Owner's equity if it's a sole proprietorship or partnership, stockholders' equity if it's a corporation. The idea is that whether you're taking a class that's focusing on corporations, sole proprietorships, partnerships, the idea here is going to be the same. It's asking for owner's equity, which means it's either going to be a sole proprietorship or a partnership, so keep that in mind. But whether you're dealing with a corporation, similar idea here. Now, students, when you're looking at the accounting equation, assets, liabilities, and equity, students usually do not have much trouble understanding the general idea of assets, future economic benefits. So these are positives, right? You've got cash, you've got land, you've got equipment, you've got a right to receive money in the future, like accounts receivable, different receivables. These are inventory. These are all types of assets. Students usually have no trouble with that. Liabilities. Students, again, usually do not have trouble. You owe someone outside the business money, or you have to provide services in the future, like unearned revenue. Equity is a little bit challenging. It's the owner's rights in the business. And you're saying, what exactly does that mean? And when you first start off in accounting, it's not clear. It's not a clear concept. When you get further into the accounting subject, you're going to talk more about equity. Like, for example, stockholders' equity. You would go in more depth with differences in terms of paid-in capital versus retained earnings and all these different items. Or if it's partnership or sole proprietorship, you'll look at specific things dealing with, again, equity. But when you're first starting off, equity, owner's rights to the business, what exactly does that mean? So there is an acronym I want you to write out, and it's WIRE. W-I-R-E. The W stands for, and again, write this out. This is extremely important. So the W is withdraws. So write out withdraws. Write this down. This is very, very important. So the W is withdraws. The I is investments. And I'll explain these and what their effect is in a moment. The R is revenue. So if the R is revenue, what do you think the E is? The E, expenses. And what these items are, these are the 4 items that basically adjust owner's equity. And when you're first learning about owner's equity, understanding owner's equity from these 4 items and how owner's equity can be changed or affected, this will help you understand owner's equity better. It's not exactly giving you the full definition of what owner's equity is, but when you're first starting off in accounting, if you can understand that owner's equity is affected by these 4 things, WIRE, the acronym WIRE, it's really going to help you grasp owner's equity as you go. And early on, the fundamentals, this is really what you need to know, what you need to focus on. So withdraws, they're going to decrease owner's equity because the owner's taking money out of the business or capital or whatever it is. Investments are going to increase owner's equity. The owner is putting money in or assets into the business. Revenues are going to increase owner's equity, and expenses are going to decrease. So the idea is that the W and I have a inverse relationship. They're related in a way, but they're inverse. So investments into the business are going to increase owner's equity. Withdrawals are going to decrease, and so they're the reverse there. Revenue and expenses, many of you already know these. Revenue minus expenses gives you net income or net loss if it's negative, and they have a contra relationship. Revenues increase owner's equity, expenses. Now, some of you might be learning that net income, net loss, that affects owner's equity. Same thing. Revenue and expenses, they equal net income. So net income is going to increase owner's equity. Net loss is going to decrease. But WIRE, make sure you write that down. So let's look at this question. We have Grapefruit Services, a sole proprietorship, starts off the year with total assets of $90,000 and total liabilities of $55,000. So right there, looking at our accounting equation, we know that assets equals $90,000, liabilities $55,000. So we can solve for the beginning. This is the beginning of the year. So at the start of the year, we can solve for equity by taking assets minus liabilities, and that will give us equity. Just use a little bit of algebra there. So 90,000 minus 55,000 is going to give us 35,000. So owner's equity, the beginning balance is $35,000. Now, the statement of change to owner's equity, what it does is it tracks the beginning balance of owner's equity. And then it shows the changes during the year, which are indeed wire, and we're going to go through those items. And then it gives you the ending balance, and that's what this question is asking. It's asking for the end of the year balance. So let's go through our wire. Let's look at the items. The revenue and expenses for the year amounted to $100,000 and $60,000 respectively. So we can actually write out WIRE. And when you look at the statement of changes to owner's equity, it might not be written in the same order as wire, but we're keeping with our acronym because acronyms can really help you understand things. So here we're given that the revenues are $100,000 because it says respectively, so make sure you note that, and then the expenses are $60,000. So we can write that. So we're going to write down revenues $100,000, expenses $60,000, and we go back to our wire and we see that revenues increase, expenses decrease. So revenues are going to increase, expenses are going to decrease. Continue on. During the year, there were no new capital contributions. So that means that investments, right? That's going to be 0. So there were no new capital contributions. And then the withdrawals, the owner withdrew $40,000. So withdrawals are a decrease and investments are an increase. Now I can tell you, I could change up the problem and say during the year there was $20,000 contributed by the owner in cash or the fair market value of equipment, whatever it is. So we have our calculation now. What we need is $60,000 to do the owner's equity ending balance and complete this problem. So if we go ahead and we calculate this, we take our numbers and we add and subtract, we're going to get we're going to get the ending balance of $35,000. And it's real easy calculation because the revenue expense nets to $40,000, positive $40,000. The withdrawals, they are negative $40,000. So basically, this all nets to 0. But of course, you would have to, that's what we're doing. So $35,000 plus or minus these adjustments, which the net effect is 0, gives us $35,000. So the end answer is $35,000. Remember, WIRE is a very helpful and useful acronym to use when you're doing these types of problems.